financing, appraisals, and waivers help. My name is Lori Levy. I am General Counsel and Vice President of Legal Affairs for Texas Realtors, and we are so excited to bring this to you today. I think you all are excited too. We are up to over 460 participants, so hopefully everybody is able to log on and you can hear and see us. I already see some questions coming in, so let me get through the mechanics of today and then we'll hand it over to our presenters. The purpose of today's webinar is to talk about some of the hot topic issues going on out there in the market, but we wanted to start with the basics. We're going to cover the Third Party Financing Addendum and then the Addendum Concerning the Right to Terminate Due to Lender's Appraisal, otherwise known as the Appraisal Addendum. This is going to be recorded. It will be posted on the Texas Realtors website after today, where you and your colleagues can go view it again. Please be mindful that nothing we say today constitutes legal advice. We are giving you information, but we cannot give you specific legal advice on any of your issues. The Q&A is turned on. Put your questions there. There is no chat function today. We will try to get to as many questions as we can if they're on topic. Please know we won't be able to get to them all, but we will have a log of them. We will go through those after this and put out more information based on your questions after today through our normal communications channels. We will also answer those through upcoming webinars on specific topics. And then again, at our Texas Realtors Conference in September in Houston, we're going to host a risk reduction forum titled How to Stay Cool in a Hot Market, where we will continue this discussion about these issues that we're seeing. And let me get right to our panelists today. It's my pleasure to introduce to you Ron Walker. He is former general counsel here at Texas Realtors. We're happy to have him back in the building. He is currently co-chair of the Broker-Lawyer Committee at TREC, and he is here as our expert on these forms and how to use them in your transactions. We also have David Jones, Senior Associate Counsel here at Texas Realtors, who'll be having the conversation with Ron. And then Robin Harris, our Associate Counsel, will be manning the Q&A and will be popping up to ask some of the relevant questions throughout. So welcome to the program. And David, I'm going to turn it over to you.
Thank you very much, Lori, and welcome everyone. As Lori said, we will be discussing the Third Party Financing Addendum and the Appraisal Addendum. It is crucial to understand these forms and how they work, especially in this crazy market. We're hearing sellers making all sorts of demands regarding offers and what the offers must contain. And we're hearing about buyers complying and submitting all sorts of crazy offers. So it is very crucial to kind of have a deep dive into these two forms. And I am very excited to have Mr. Ron Walker here to discuss these. So let's get started. Ron, if you could give us a little background on both of these forms, sort of give us a little history so we can all start sort of from the same point.
Sure. Thank you, David. Thank you, Lori, for the invitation to be here. It's always affirming to see Lori in her role as general counsel, because I take pride in claiming that we stole her from the Senate staff and persuaded her to come over to work at TAR many years ago. The appraisal addendum is, I know, what we're here primarily to talk about, especially in the unusual market that we've had, or maybe it's a newer type of market, being a strong seller's market, and it's raised a number of questions. But of course, the appraisal addendum only works in connection with the third party financing addendum. So I'll back up just a minute. I think it's worth spending a couple moments to just look at the third party financing addendum, take a quick view of that and get a quick understanding of it. The history of the third party financing addendum goes back to the very beginning when the forms were first being drafted back in the 70s. It originally was in the contract forms themselves and eventually moved to an addendum. But the purpose of it, of course, is to create a financing contingency, a contingency in which the buyer says, I'm going to go ahead and buy the property, but I've got to get a loan. And if I can't get that loan for some reason, then I want to be able to walk away from the deal and to be able to terminate. And the market was always there in allowing that to take place. And that's pretty much the way the market had operated until more recently, when we have the seller's market and we began to see where maybe the buyer wants to waive some of those rights to be related to that contingency. So the market relied on that. I think as the years progressed, the industry began using the pre-qualification process, the pre-approval process to try to expedite that approval and contingency along in the transaction. But when you look at the form, and you might want to go ahead and pull up the third party financing addendum so that we can kind of walk through that, you'll see that the third party financing addendum essentially mirrors what takes place with regard to a typical buyer in applying for a loan. So what the buyer in doing and creating the contingency, he's first making a promise in paragraph 1 that he's going to apply for a specific type of loan. And he's going to make every reasonable effort to obtain that financing approval or that loan approval for that loan. So one of the things that we should keep in mind is that a buyer does have a duty to apply for the loan that he defines in paragraph 1. Now, he has the freedom to apply for multitude of different types of financing if he wants to, but he needs to make sure that he's at least making every reasonable effort to obtain that financing that he describes below. So when you check box A or B or whatever type of loan is the buyer is going to apply for, it's prudent to be specific there as to what type of loan the buyer in fact wants to apply for and intends to apply for. From a seller standpoint, I would want to make sure that that loan is reasonably available out there in the marketplace and that there's a good chance that a typical buyer can find that type of loan. In years past, especially back in the 1980s when interest rates were extremely volatile, it became critical for the buyers to specify and be very good about specifying the loan terms, specifically the interest rates and the origination points or the other points that might be associated with that, because then it was well defined as to when the buyer had the ability to exercise his right to terminate if he didn't get the loan specified there. Now, as I said, the buyer can choose to close with any other type of loan as long as it doesn't cost the seller any additional money or delay the transaction, but he needs to make sure that he's applying for that. One of the things that's extremely important when we look at the appraisal addendum is going to be the loan to value ratio, the calculation there. So what I specify in that paragraph 1 is going to be important with regard to loan to value because it's going to determine what rights I have to a large degree. So if I'm buying a $400,000 house and I'm only going to put 10% down, then I'm obviously getting a 90% loan to value ratio. Obviously, if I put down more, then that loan to value ratio will go down as well. And then if you drop down a little bit and go down to paragraph 2, that's really the meat of the financing condition addendum. What the buyer is saying there is, I want to make this offer here or this contract contingent upon me obtaining the financing, contingent upon me obtaining loan approval. So we should ask, what do we mean by loan approval? What is loan approval? Well, loan approval is that unequivocal statement by the lender or that unequivocal commitment by the lender that says, I'm ready to fund, I'm ready to hand over the cash. That's when we have loan approval. And usually there's a whole process to get to that loan approval process before the lender is ready to make that serious type of commitment. Generally speaking, there are 2 major elements to obtaining loan approval. And of course, those are buyer approval and property approval. So in buyer approval, the lender is interested in looking at the buyer's ability to repay the loan. Look at the individual there, his or her income, his credit worthiness, credit score, his source of funds for a down payment, his employment history, all of those types of things, and he's looking at his personal ability to repay the loan. Now, those are generally items or documents for which the buyer has fairly good control. And he, especially if he's been working to get those ahead of time, he should be able to get those over to the lender. And so the buyer approval process, just looking at the buyer, hopefully can happen fairly quickly, usually within a couple of weeks or 3 weeks or something along those lines. And the lender can then say, yes, this particular buyer is qualified for the loan, and we can in fact commit that we will approve the loan. Now, the second major element to obtaining loan approval is that the lender has to be satisfied as to the collateral. So as a lender, I want to make sure that the collateral for the loan is going to be sufficient for whatever underwriting requirements that I have. And for this particular type of transaction, this third-party financing addendum, that is the property. The property is the collateral. So we call that property approval. And there, the lender is looking at the physical aspects related to the property, its location, its access, its insurability. There may be some issues related to title that will come up, all that the lender has to approve. For our sake, we're only interested in one of those this morning, and that's the appraisal. What is the value of that property as determined by a independent appraisal? And so we can assume for our discussion this morning that there is all the other elements have been properly satisfied. Now, the appraisal, as we know, is usually one of the last things that comes in that whole process. And once the appraisal's in, then it can go to underwriting, and underwriting can give approval as to the property, the collateral itself. And then that's when, of course, the lender is able to say he gives loan approval. But you'll notice in paragraph 2B there that there's a statement that says if the lender, if the property does not satisfy the lender's underwriting requirements, then the buyer may terminate the contract. And so when it comes to the appraisal here, that's when the loan to value ratio is going to be important in terms of the calculation. So if we take that example again of I'm buying a property for $400,000, I want to put down $40,000. I apply for the loan, all is good related to my creditworthiness, and the appraisal comes back, and this time the appraisal comes back at 375. Perhaps it was listed at 375 and I made an offer at 400, and the appraisal now comes back at 375. So now I have to evaluate as a buyer, what am I going to do? Because I'm not going to be able to get a loan where I'm only for $360,000, which is what I had intended. Instead, the lender is going to base his loan amount and his loan to value based on 375. So the lender is going to tell me this property does not satisfy my underwriting requirements because of the value. So I would have the right to terminate in that particular case. Now, I can choose to put some additional money down because my loan amount is going to be a little less than 340 now. I have to decide whether I want to put that extra cash down and proceed with the contract, or go ahead and exercise my right to terminate under paragraph 2B. Now, if you switch the facts of what I just gave you just a tiny bit, you can see how the loan to value ratio plays out very importantly in this determination. If we change the facts and say I was going to put 50% down, $200,000, then when the appraisal comes back at 375, even though I agreed to pay 400, the lender is going to say, I'm okay. I can loan you $200,000 based on a $375,000 appraisal. So in that case, I would not have the right to terminate under paragraph 2B because the property still satisfies the lender's underwriting requirements. So as a buyer, the question comes back is, what did I insert in paragraph 1? And then I can determine whether or not that right to terminate actually exists or does not exist in paragraph 2B. The only other paragraph that I want to mention in the addendum is paragraph 4, which is the FHA and VA required provision. That provision.
Vaughn and David, excuse me, sorry to interrupt. We did get a couple of questions that I just wanted to clarify on. Earlier, you'd mentioned about conventional financing, or did you say earlier that if you start with conventional financing check, but change to an FHA loan after going under contract, that you can do that without getting permission from the seller or to amend the contract?
You can close according to some old case law. You can change the financing whatever you want, provided that it does not cost the seller any additional money. So there are some unallowable costs that I understand that FHA and VA do not permit the borrowers to pay. So that can be a problem, and it may prohibit him from switching to an FHA VA. The other will be that it cannot cause the seller, can't change the contract in any way, so that, well, if there's an extension in closing that's necessary, you'll have to amend the closing date. But it can't cost the seller. In other words, the seller has to be in the same position as if he would have closed, regardless of the financing that the buyer actually chooses to close with.
Okay, great, thanks. And just, David, if you could maybe zoom a little bit more onto the form. Some viewers are having a hard time reading it. I think that looks great. Thank you.
Okay.
Those are probably viewers like me that have a hard time these days. But the VA FHA clause, that clause right there, is generally known as the amendatory clause. I suspect, although I don't know, that it's called the amendatory clause because many times contracts will be coming into the lenders or the underwriters without that clause in there. And then the lender then sends back a requirement that has to now be included in the contract. And so normally goes on as an amendment. But many years ago, the Broker-Lawyer Committee opted to place that language in the Third Party Financing Addendum in order to expedite that process, so you wouldn't have to do an additional amendment. But as what that addendum does, and again, this is required by FHA VA in their underwriting requirements, is that it gives to the buyer the ability to terminate the contract if the appraisal comes in below the sales price. Now, you will notice that there's a line to fill in for FHA transactions in the middle there of paragraph 4. According to the underwriting guidelines, that amount has to be at least the sales price. So I don't have the option as an FHA buyer to put something less than the sales price there. I need to put the sales price or more. So essentially, both FHA and VA say this buyer has to be able to walk away at his choice, his option, if the appraisal comes in below the sales price. And then of course, he also has the right to negotiate something less, or he has the right, of course, to come up with some additional cash if he wants to and go ahead and proceed in the transaction. But the loan will be based, of course, on the appraised value if the buyer chooses to pay more than the appraised value. So that's the high level look of the third party financing addendum. And if you can switch over to the appraisal addendum.
Well, before we switch over, we do have some kind of frequently asked questions that we get about the third party financing. If I could share those with you. One, we get questions about the difference in the timeline to terminate under the buyer approval paragraph versus the property approval paragraph. If you wouldn't mind kind of discussing that a bit.
Okay. So what the buyer is agreeing to do under paragraph 2A is to say I have a certain amount of time to confirm with my lender that the lender is going to approve me as the buyer. And if I determine, let's say within that time period that's specified in there, let's say I put 21 days. If I determine sometime before 21 days, the lender saying to me, no, Ron, you have this history in your creditworthiness, I'm not going to be able to get that loan for you. Then I'll be able to get a letter from the lender saying, I'm not going to get buyer approval, and therefore I'm terminating within that time period. If I choose to go beyond the 21-day period, then and the lender later comes back to me after the 21-day period and says, I'm not going to approve you, Ron, because of some history and your creditworthiness, then that's not going to be a basis for me to terminate. So that's that one. And then the second one under B deals with the property itself and why the lender is refusing to give loan approval, and it has to be based there on the property itself. So the lender might come back and say, we have an access issue because there's this easement going across the front of the property and we don't like it, so it doesn't satisfy our underwriting requirements. Or as we're talking today, the appraisals come in too low, so I can't give you this loan, then I would have that right to terminate. Property approval, as I mentioned, usually takes up until the closing date many times to actually get. It's usually the last thing in the transaction to get, and that's the reason why the Broker-Lawyer Committee put in 3 days before closing as the deadline by which to exercise that right to terminate under paragraph 2B, as opposed to, let's say, a shorter time period measured by the effective date.
Thank you. Regarding that, we also get questions about this language, not later than 3 days before the closing date to terminate. How do you calculate those 3 days? Say, for example, we have a closing date that's set for Friday. If we start counting backwards, 1 day before would be Thursday, 2 days before would be Wednesday, 3 days before would be Tuesday. So when should a buyer terminate if the 3 days before closing is that Tuesday? Should they terminate on Tuesday, or should they terminate even before that on Monday?
Even before that on Monday at the latest. So you calculated exactly right. If you think of this particular phrase, instead of the words 3 days before closing, if you think of the words, it says you may terminate no later than, and then if you were to insert a date certain, let's just say it was a blank date, if you could insert that date, what you just did is that you calculated a date certain by using 3 days before closing. And then you determined that 3 days before closing was everything before Tuesday. And so therefore Monday would have been the correct answer, or before that time period.
Okay. Here's another one we get at the, let's see if I can highlight this. For buyer approval. Sometimes a buyer says, you know what, my credit, my income, my assets, they're great. Buyer approval is certain, so I'm going to check this box, that this contract is not subject to buyer obtaining approval. Buyer is taking the risk that they won't get buyer approval. If that box is checked, can a buyer still terminate under 2B property approval?
Yes. Yeah. So even though the contingency in 2A goes away, 2B still remains. And the idea, the thought behind that is that originally that because I have control and knowledge of my own creditworthiness and the history of that, I can easily waive that and be informed. But since I'm not truly familiar with all the issues, I haven't seen the title work related to this property, the condition, I haven't obtained an appraisal, then I don't know if I can make that same waiver with regard to B.
Okay, Robin, do we have any good questions out there about third-party financing before we move on to the appraisal addendum?
What about can the seller require documentation from the lender to verify denial of the loan approval where the buyer is trying to exercise their right to terminate?
Right. So obviously, since the lender is not a party to the contract, he can't require it of the lender. Now, he can require it from the buyer. So what you would want to do is to be able to require, if you're going to require something, is that you would want to be able to require something that you know the buyer can reasonably get his hands on. And so, for example, in the appraisal addendum, you'll see that providing a copy of the appraisal report to the seller is a reasonable requirement. So there are certain things that you can require. If you can't if the buyer can't reasonably obtain it, he's going to have a difficulty in complying with that provision.
And then what about, we've had several questions about the amount in the FHA VA provisions.
Right.
Property value and including that, if you put more than what it appraises for, for your loan as a way to get around undervalued or underappraised, low appraised properties.
Right. So the underwriting requirements for FHA and VA, if I understand them correctly, require. Thank you for pulling that up. If you scroll down just a little bit, I think right back up just a little bit. It should be right there. So you can see that the amendatory clause is required. Oh, I'm sorry. Keep scrolling. I think I put an arrow there. There you go. So the actual dollar amount to be inserted has to be an amount at least the sales price, according to the underwriting requirements. So obviously, if I'm selling a property, let's say in a balanced market, if I'm selling the property and we've agreed upon a sales price, I'm not going to want to agree that it has to appraise higher than the sales price. I want to bind that buyer to go forward and purchase as long as the appraisal comes forward in an amount for the sales price. But I guess that could be negotiable as long as they put at least the sales price.
Okay, well, I think we're ready to move on to the appraisal addendum.
So in the appraisal addendum, the best way to sort of think of the appraisal addendum here is, I think at least, if you think of it in two parts. If you scroll out just a little bit, you can see how, yeah, there we go. So the bottom part is the typical clause that would favor the buyer ability to terminate related to appraisal, whereas the top part, paragraph 1 and 2, deals more with the idea that these are favoring the seller. And so just depending on what type of market that you're in, you can take a look. So I would say up until recent years, when the market was more balanced, or in times when we had a buyer's market, buyers were always concerned, or many times concerned, that they would be paying too much for the property. And they wanted to be able to terminate on the basis of the appraised value, regardless of what the lender might do. So if we go back to one of those examples I gave to you, where I'm going to buy a property for $400,000, but I'm putting $200,000 down, but if the appraisal comes in low, let's say at 375, I may want to have the ability to terminate, even though the lender will choose to make the loan and approve the property anyway. So that's paragraph 3. Paragraph 3 is giving that additional right to the buyer to be able to say, I don't care what the lender says. If the appraised value comes in less than a certain amount, and I might choose the sales price, $400,000 in my example, then I have that right to terminate and deliver a copy of the appraisal to the seller. So that's what I would call sort of this traditional appraisal clause, when many years ago we were talking about can we draft an appraisal clause? That's typically what was thought. Whereas in paragraph 1, about the time that the Broker-Lawyer Committee was looking seriously at adding this as an addendum, it was about the time that the market had already changed and was becoming, in many parts of the state, a much more of a seller's market. And we began to hear that sellers were requiring buyers to waive their rights to terminate in the third party financing addendum, and to take that risk that they would close. And we saw different versions of different types of clauses like that. So paragraph 1 simply says, as the buyer, when that lender appraisal comes back, I am not going to terminate under paragraph 2B. And so I'm waiving that right in paragraph 2B altogether. And that's what paragraph 1 says. At the time that the Broker-Lawyer Committee was drafting that, there were comments that were coming in and saying, I don't mind waiving it, But I need to cap that a little bit because, you know, if the appraisal comes in significantly lower, my buyer may not have the cash to be able to make up the difference. And so paragraph 2 sort of places that cap in place to be able to say, I am going to waive that, but only if the appraised value doesn't drop below a certain amount. And so that's the difference between 1 and 2. They are very similar to each other, but 1 does not have a cap. It's a little bit more risky for the buyer, if you will. And under paragraph 2, he kind of caps what his risk might be. I will mention the lead-in sentence because I know that sometimes there's been some reports that we have, there's been attempts to use this addendum with the FHA VA transactions. And so you'll see what I highlighted there at the top of the form where this says this addendum may not be used with FHA or VA financing. And also note that it must be used in connection with the third party financing addendum. So for this addendum to be attached, the third party financing addendum needs to be there because what this addendum is talking about is the waivers in paragraph 2B. Now, if you try to use this addendum with an FHA VA financing, really what you're doing is contradicting what's in the addendum, third-party financing addendum with regard to the mandatory clause that FHA and VA require. So in essence, what you're doing is you're adding what FHA VA says that you're required to do, and then you're immediately taking it out. So it obviously wouldn't work for underwriting purposes. That's the quick overview of that form.
Okay, we do have a couple of frequently asked questions regarding this form. One, we get this question a lot and we don't read it in there, so we're not sure where. I think maybe somebody started a rumor that paragraph 2, when the appraisal comes in lower, is the seller required to come down to the appraised value under that paragraph?
No, that form does not, or that clause does not require that.
Another question we get about paragraph 2 is this last sentence down there: if the lender reduces the amount of the loan, that the cash portion of the sales price is increased by the amount the loan is reduced to. So basically the buyer's got to come up with extra cash. The form only allows you to put in the opinion of value. So that's the cap that you're setting, is basically how low the appraisal is going to go. And some buyers, I guess, are instead not wanting to use that as their cap, how low the appraisal goes. They're wanting to use how much cash that they're going to bring. Your thoughts about trying to do that with this form?
Right. So we need to do a little math to accomplish that.
Okay.
We can get there. It just requires a little bit of math. And again, what we're talking about here is a form that's designed to waive something that's referenced in paragraph 2B of another form. And so that other form refers to the appraised value. So this form, therefore, should refer to the appraised value because that's what you're waiving. So if, for example, taking my example of $400,000, and I originally wanted to put $40,000 down, but I can stomach, if I have to put $80,000 down if necessary, then I could put in, so there I just simply put in $320,000 as the cap there in paragraph 2. Is that 2?
Paragraph 2.
Paragraph 2 in Roman numeral 2. So that would be, you just kind of back into the math just slightly there.
Okay. The other question we get a lot is, the form says don't use it for cash deals, don't use it for FHA VA financing. When we get that question, say on the legal hotline, it's not something we can really answer on how to get this in a cash deal. Basically, we have to refer them to a private attorney to discuss and maybe draw something up. Is that sort of your opinion as well?
Right, absolutely, no doubt about it. So with regard to our knowledge, with regard to FHA and VA and what they require in the underwriting requirements, my guess is the attorney would probably reach the same conclusion that we've reached, which is it's not going to be possible unless you get a sort of a commitment from a lender. So as an attorney, I would advise drafting against that kind of a clause unless I got some sort of assurance from the lender that says, oh, no, you can waive that mandatory clause, and I obviously would want that in writing with a little indemnity.
Okay, sticking with sort of cash offers, this question deals with, so-called hard money loans, or, investor that they are going to get a loan, but it's not one of the sort of the pre-printed loans on the third-party financing addendum. So they're writing their offers as cash offers, even though they know they're going to get a loan from somewhere. I understand that the Broker-Lawyer Committee recently took up this topic. Could you share any thoughts regarding that?
Oh, absolutely. Yeah, there were a number of comments received at the last meeting. Broker-Lawyer Committee met last week, and they were related specifically to that. So you have a number of different possible, what we call private loan sources that were referenced as hard money. For example, parents making a loan to the kids who are buying the property. Or maybe I have a portfolio, investment portfolio that I'm going to use as security. I just go ahead and getting the loan. And maybe I want to go ahead and get a lien drafted up that way so that that can take place as well. So what I want to be able to do is, in those regards, the question that came up is, does the buyer then draft those hard money type of situations or transactions as cash? And the answer would be yes, because he's simply coming to that. Now, what could happen, of course, is that you could draft something up in addition to the third-party financing addendum describing the addendum for it to apply, but you wouldn't need that if the money is pretty well secured in getting it. So it's simply a cash transaction. Broker-Lawyer Committee is looking at whether or not certain representations would need to be made or not. But in a cash transaction, of course, the buyer takes all the risk that he's going to get the money. And if he can't get the money by the closing date, then he'll be in default.
Okay, thank you. Robin, I see a ton of questions going on. We know by far the third-party financing and the appraisal addendum, these are the questions that we're getting the most on the legal hotline. So what do you have for us?
Yeah, it's just there are a lot of questions about what to do if your buyer is qualified for a VA or FHA loan, but they want to bring more cash. How are they able to get that into the contract and communicate that?
Well, in terms of communicating that, I would suggest that what they have to communicate to the seller is, we're still going to go get an FHA VA. Here's our pre-qualification letter, or pre-approval or conditional approval letter. And then we also have some cash. And so we're going to not terminate. But the problem is that you have there is that language there does give the buyer the right to terminate. So as the seller, I'm taking the risk there that they're going to later change their mind and exercise that right to terminate if the appraisal comes in low. So I have to be comfortable another way in moving with that transaction. Some have suggested, well, just get a big chunk of option fee money up, or then get something else drafted up that might be acceptable to the seller. But you'll notice that FHA and VA addendum indicates that there can't be any penalty or loss of earnest money for exercising that right of termination. So we're pretty much left to, at least in my opinion, left to asking for a much larger option fee.
And then as far as the language goes, that would just be something that the buyer would work with an attorney on getting on an addendum or in the special provisions?
I think so, but like I said, because of that language in the mandatory clause, I haven't been able to figure out a way that allows the buyer to avoid that. So, or the seller to be able to pull that right away from the buyer. And so all you can do essentially is trust that the buyer won't exercise it. And then you, again, just have to be satisfied that that's going to happen. And like I said, the only way that you can be compensated for that if it does happen, I think, is through an additional option fee or more option fee money.
And then, you know, there are still just some questions about the differences between, on the appraisal addendum, paragraphs 2 and 3. And I know, Ron, that you'd said paragraphs 1 and 2 are generally for the benefit of the seller. That's why we have it highlighted there, and paragraph 3 for the buyer. So we do have some examples, but David, do you recall some of the examples that we've used previously, or is this something, and I apologize, I'm trying to keep up with some of these questions going on here. Just still, like, it's tough to do it when you're not actually in the middle of the transaction, right? Or have concrete examples. So I think that that's just the what some of the questions are about.
Well, I'll jump in. We do have a couple of articles that we've written on this. I don't know, Robin, maybe you can share links with those. As far as, we have an example when this addendum was first promulgated by TREC, that went through each one of the options, and it gave examples, number examples to walk through all of them. And then we put another article, a shorter article, that basically kind of explained all this in layman's terms, if you will.
Yeah, if you go onto our website at texasrealestate.com, we have a great search function in the top right corner of the website. And I do it all the time when I'm discussing these issues with callers on the hotline. Just type the word appraisal, and it'll bring up all of our blog posts and articles that we put out over the past couple of years that have those explanations with examples. So I would recommend texasrealestate.com, log in and do that search.
I've seen a few questions come in that kind of get back to the basics of, and an issue that we're seeing right now with appraisals getting backed up. We know that there are some issues going on with the number of licensed appraisers. They just now, in the recent legislative session, got the ability to do evaluations, not the full appraisal, but it does seem to be taking longer in this hot market for appraisals to come in. Can you address that a little bit, and what our members need to know about that as they're getting closer to the closing date and the appraisal hasn't been provided yet?
Right. So I've run across a couple transactions here recently where we were selling some property, and the buyers, in talking, when we have just a discussion with the buyers about where they are even before we went under contract with regard to their status with the loan, and do they have the loan and this type of thing ready to go. That was the common thing. They said, we don't, the lender said, we've given everything to the lender. We have the conditional approval, but the lender says he's backed up on appraisals at least 6 weeks. And so we're like, okay, well, are we willing to take the risk and not close for 6 weeks? And then that becomes an issue with regard to other concessions that we might be asking with regard to the closing date. With regard to the standard forms, without going in and changing the standard forms, it's just something that should be discussed, I think, between the brokers about the buyer's status and also about the length of time that's reasonably necessary for the appraisal to come in. Otherwise, you'd have to be dealing with changing the form and moving into the unauthorized practice of law, which I won't go down that route right now.
We've also had several questions about the earnest money. If a buyer terminates pursuant to either this addendum or third-party financing addendum, what happens to the earnest money?
Assuming they're exercising their right to terminate properly, then both provisions allow the earnest money to be returned to the buyer in that particular case, because he is exercising a contingency right in accordance with the terms of the contract, the third-party financing addendum or this particular addendum. So he should be able to receive the earnest money back. Go ahead. One of the questions that I'm just throwing a question that I received the other day related to the hard money scenario was a buyer comes in and makes a cash offer and tells me that they're going to obtain a loan, they're going to use it for collateral, but they do have everything done. They're not making a contingency here. And how do I go about verifying that as the seller, or am I just taking the property off the market for a period of time? And of course, what you try to do is obtain the source of that information, verification as best you can. So just like in seller financing, if you refer to the seller financing addendum, there's provision in there for delivery of documentation related to the buyer's ability for the loan. And here, and part of that might be a source of funds. I need a letter from your bank or from your brokerage account or wherever you're getting the money that verifies that. Now, that's not to say that that won't change the next day if the buyer has the ability to move those funds out. But again, that would be a way of looking at that. We're talking to an attorney about somehow or another seeing if there's a way that you can hold that money or receive notice if the money is actually moved or withdrawn prior to the closing date.
And Ron, we did get a question. Can you talk a little bit about what the impact of increasing your down payment, the greater your down payment, how does that affect the need for a partial waiver or waiver at all, say a 50% down payment on your property?
Right. I think that's an excellent question, because in a conventional loan, obviously, if I'm putting 50% down in the example that we're using a $400,000 sales price with $200,000 down, chances are I am not going to ever even get to the point of having the right to terminate under paragraph 2B of the financing addendum. So as a seller's agent, if I see that much down and I'm confident that they have the money to put down, then the appraisal addendum is not going to be really even be necessary, because we're not even going to get to the buyer's ability to terminate under paragraph 2B most likely. And then if the buyer doesn't have the cash, then he's going to be in default.
Can we talk about that for a moment? In this market, we are seeing those types of scenarios where buyers are bringing more cash, or then later deciding to bring more cash to make the deal work, or offering a cash offer when they are still going to get a loan from a bank. Some of the issues we're seeing or questions that are coming across is, what protections are there for the cash buyer? Probably not a lot. They don't have that opportunity to get an appraisal. But what are, I've lost my train of thought on the question I was going to ask. The title company is sometimes stepping in and saying, you do need a financing addendum on this. I think the creativity of the market is raising these issues. What do you say to listing agents who are seeing these cash offers or high dollar cash down payments coming in about proof of funds? How can they advise their seller on that confidence level that you talked about a moment ago, when you can't put a hold on that money?
Right. So obviously, in the first part of that question, Lori, was the idea of being able to say, I'm drafting up a cash offer. We've gone under contract. And let's say legitimately I have the cash, I have it in a brokerage account or wherever it might be, But now, shortly before closing, I decide that I want to go ahead and have my bank or someone else give me a loan in order to, by securing the property, so that I can take advantage of whatever tax breaks, or maybe it's a better financial decision for me. I change my mind. So that lender now is going to, I'm going to need to put them in contact with the title company. I'm going to make sure that the lender is satisfied, and I've got to get all that done by the closing date. And so if the lender doesn't require appraisal, maybe I'm going to secure that loan with some additional collateral in addition to the property. So they may waive the requirement to get the appraisal, especially if it's a bank or something like that, a flexible lender. So that's going to be some of the issues that will come up, the specific issues that will come up that will allow that to take place. But again, the bottom line for the seller is that his position and the contract doesn't change unless, of course, we agree to amend the contract in order to accommodate this. Now, with regard to the money, otherwise verifying the source of funds, to me, those conversations are important to have between the agents, in possibly even in a conversation between the agents and the parties that need to understand what's going on, so that we know where your money is, that we can verify that money, and that we can see about getting some agreement in place for proper notification. So much like we do when we negotiate insurance coverage from one party to the other party, we can get a commitment from the insurance company that says if this insurance ever changes or goes away, then the other party is notified about that within a certain period of time. Should be able to negotiate those kinds of things with the lenders, but they're unusual, and so they obviously all need the assistance of counsel in getting those commitments made. Otherwise, you pretty much just have to rely on the source of information that you have, and obviously there's some degree of trust that that's actually going to take place. So hopefully in the seller's market, that's sort of built in, because we know that there are abundance of buyers who will buy the property at hopefully that same sales price. And so even if that buyer walks on you for some reason, the potential injury or damage is minimized.
And just to be clear on this, to some of our viewers, a complete waiver in that paragraph 1 there on the addendum, that eliminates the buyer's ability to terminate pursuant to the third party financing addendum. Would that be a correct statement?
That's correct.
Okay. So if paragraph 1 is checked, that's a full waiver. And so this essentially cancels out that paragraph 2 for a conventional loan termination.
That's correct. So that's probably a good reason why you don't see that checkbox that you see in 2A, also in 2B, because the waiver, the choice is, are you waiving completely, or are you going to want to cap that waiver in in paragraph 2 of the appraisal addendum?
I've gotten a question regarding FHA VA transactions. Let's say the seller does accept FHA VA buyer. We now know that you can't waive this provision. It's federal law. So the buyer, FHA VA buyer, is going to have the option to terminate if there's a low appraisal. Let's say they're in the transaction, they do get a low appraisal, and the buyer will now elect to go ahead and finish it off. They're going to complete the transaction. They're going to bring extra cash. What can the seller do to kind of tie the buyer down so that the buyer doesn't say, oh yeah, I'll go ahead and buy the property, and then a day before closing say, oh, wait a minute, paragraph 4, I'm terminating.
Right. That's a good question. You know, I hadn't thought through that one completely. I suspect what I would do is to get some sort of written statement from the buyer here saying that we have now been provided a copy of the appraisal or the notice of the appraised value from the lender, and that we are proceeding to go forward, and we're not going to be terminating under paragraph 4 of the third party financing addendum. And I think that's consistent with, my first reaction is that's consistent with what the language in paragraph 4 says, that they can go ahead and agree to proceed. So I think that would be a choice that has now been made. Now, as the buyer, you may want to say, well, why would I make that decision until closing? But I guess they could go ahead and make that decision.
And as we're getting close to the end of the hour here, just can you clarify, Ron, as far as on the third party financing addendum and the total waiver in paragraph 3 on the appraisal addendum, what exactly is property approval? If the property doesn't appraise, is that all that it takes?
Well, for the purpose of our conversation, obviously we were talking only about appraisal and value today, but no, there's a lot more that goes into property approval than just the appraisal itself. The location in the flood zone, for example, if you're buying a condominium, for example, the approval of the condominium association by HUD, for example, or FHA, if it's one of those. Certain lenders won't make loans in certain types of subdivisions or whatever it might be. So there could be a number of different questions that come up related to property approval. For example, I mentioned the access issue, the title issue, the easement issues, all those things that the lender may say, no. You know, they usually give you quote unquote loan approval, but then have the 4 or 5 things that have to be satisfied at or before the closing date.
Ron, I'm going to throw out the last question, and it's, I think, an easy one. Back on the appraisal addendum, David, I'm seeing a lot of questions come through regarding paragraph 3. And I think it's worth pointing out, like you did earlier at the top of the form that has some language on there. In paragraph 3, it says right there, additional right to terminate. And then that first part of that sentence, in addition to buyer's right to terminate. We do still get a lot of calls on the hotline, and I'm seeing it in the questions today, confusion about how this paragraph works in conjunction with the third party financing addendum. A lot of members think that it's just repeating the out that's in the third party financing addendum.
Right, that goes back to the best example of that goes back to the loan to value calculation. So the example where I was putting $200,000 down and buying a $400,000 property. So the appraisal comes back now at 375, and the lender says, well, I'm only loaning you 200, so I'm okay. The property satisfies my underwriting requirements and I'll make the loan. And I said, well, I don't want to pay $400,000 for a property that's been appraised for 375. And so this paragraph gives me an additional right that I don't have in that example in the financing addendum.
So prior to this addendum coming into play under third party, you didn't have that additional right as a buyer, but this allows for that.
Right, in that example that I gave you, yes. So that's where the loan to value ratio becomes, again, so important when you look at your right to terminate under the third party financing addendum. And then if you're attaching this clause eliminates that worry for the buyer.
Yep. I hope that we've cleared that up for our members. I hope we cleared up some other areas, specifically on FHA and VA and on these 2 forms generally. As I said before, we will post this to our website so that you will have access to it. I should also mention this was not offered for CE. Some members were asking that question. It was not CE. It was just merely for your knowledge. I want to thank Ron Walker for coming back to the building and doing this for us. Thank you to David and Robin as well. We look forward to seeing you on future Legal Series webinars. Look for updates about those through our regular communication channels. And with that, we will say goodbye to everyone. Have a great day. Thank you.
Thank you.